Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder, and CEO of ZANA Investments, Tim Little. And on today's show, we have with us Paul Winterowd. Paul is both an expert debt provider and active multifamily investor as both a general and limited partner. Paul has successfully sourced mortgage financing across the country for market rate and affordable housing, affordable apartment buildings, student housing, senior housing, self-storage, and industrial projects. He has been a GP on 5 deals and has invested as an LP in 38 deals. Paul, welcome to the show.
Thanks, Tim. Great to be here.
And it is great to have you. So I gave everyone a high-level overview of your background there, but on this show, we really like to get into the details of how you got started on your journey to multifamily millions. So talk to us a little bit about what brought you into the multifamily?
Sure. The story's different, and I feel very fortunate to be in the seat I'm in. So my whole life, I'd say middle of my life, but hopefully on the front 9 of life, maybe on the back. I'm 45 currently. I do a little golf reference there. I do love to play golf, and I actually played in high school and collegiately. And it was crystal clear to me that I didn't have much of a future in golf if I wanted to eat regularly. So I was good enough to play collegiately, but not professionally. And so started down the career path, not really knowing what I wanted to do. I've always had an interest in real estate and finance and just wasn't really focused or clear on what I wanted to do. Went back to business school in 2008, wanting to get into the finance world. Well, if anyone does the math, 2008 to 2010 was the downfall of real estate and the finance industry at large. And so it wasn't really good timing coming out of grad school to get where I wanted to go. So I actually spent a couple of years in the marketing space and was able to, when the opportunity presented itself, I was able to start as a mortgage broker on the commercial real estate side. And I focused initially on multifamily assets. There were a lot of reasons, but what was really intriguing to me is up until that point in my life, and that was about 8 years ago, I'd see apartment buildings or commercial real estate, and I think, well, whoever owns that must have it all figured out. They must be doing pretty well in life, and it's this passive income. And frankly, knew very little about it from the outside looking in, but thought, hey, that'd be great. And so having an interest in real estate and having this opportunity to be a mortgage broker, I thought, hey, if I can really figure out what good financing looks like and what projects are financeable, I could leverage that as an investor. And I really thought that was well down the road, and I didn't know when that would come to fruition. But really, after about 3 years in the business as a mortgage broker, having been drinking from the fire hose and learned a lot, partnered with an individual, actually a broker on the side that was more CRE transactions, and we were working together and got to the point where we said, hey, we're helping people do this, why don't we do it ourselves? And so again, a little bit of an exercise of building the airplane in the air as we were flying, but jumped in and did a handful of, I'd say, smaller multifamily syndications in that 20 to 60 unit range. And so that was we had a lot of success. We were benefiting from great timing in the market, which a lot of us have benefited from the last 4 or 5 years. And on the GP side, we were fortunate to have profitable exits from all those deals. And for me, at least, I realized that the GP side is another full-time job, especially with scale. Maybe one property, but you start looking at value add and managing the manager and investor relations and all those things. It takes a fair amount of time and energy to do it well. And what made most sense for me was to focus on the passive investing and continue on in the day job, if you will, as a mortgage broker. And so I took the profits from those GP interests, the general partner interests, and started spreading them out, building a portfolio of investments that is in multiple states and with different general partners or syndicators in a space I know and have a lot of faith and confidence in that, primarily multifamily assets, but that's where the passive investing is in real estate. So there's a lot of gurus and training programs, and the front end of marketing real estate training is all about this passive income. Well, the passive side truly is, in my opinion, the that LP, that where you wire in some money after doing your diligence, of course, and then sit back and get the distributions and hopefully a nice exit a few years down the road. So that's worked well for me, and where I intend on living as an investor for the immediate future. Very much enjoying the mortgage business because the two really help each other. Every deal that I work on is a different set of circumstances, different nuances, different challenges. It builds my network. I get more exposure to great syndicators and operators, as well as different markets and all those things. So I don't have all the answers or all the knowledge, but in a sense, it's a bit of an unfair advantage to someone working outside the industry, because essentially my day job gives me a lot of knowledge and insight as far as due diligence. So when opportunities come my way, I can make a quick decision.
Yeah, and there's so much good stuff there to unpack. I'll go back to the beginning. You talked about coming out of grad school in 2008, and I feel like 2008 in general is just one of those things of our generation where we're like, I remember where I was when that happened. And for you, you were just coming out of grad school, which is definitely an inopportune time. For me, it was interesting because I was just going into grad school and I was studying global trade, economic integration, and what a time to be studying those things when it was basically all falling apart. It was like this giant worldwide case study that we had at our disposal, but we didn't know how it actually ended.
Yeah.
And then I was graduating originally in 2010, but as you probably remember, the job market still hadn't really recovered by that point to any great extent. So I was like, what am I going to do? And luckily, the school I was in had a dual degree program. Mine was focused on like international trade, but they had a dual degree program with the business school, whereas I could get an MBA for just doing like one additional year. And I was like, just the putting it off for one more year to let the economy kind of recover and come out with an MBA, I thought I would be setting myself up a lot better with that. But it's, again, just interesting timing for everyone during that 2008 period. But I'm sure it's had an impact on all of your investing moving forward, just having seen that. It's one thing if you're invested during that period, which I wasn't from a multifamily perspective, but I've talked to folks who were, and it's almost traumatizing for them, but they take a lot of good lessons having persevered through that time.
Absolutely. I mean, it's such a unique situation we're in economically now, because there's a lot of good news and a lot of bad news, and so much of the extended run that we've had has been a product of very cheap money, probably artificially depressed interest rates, and so we're normalizing there, and I think that's healthy. I think the market was really frothy, but it's not going to be as good for the next couple of years. However, we look back at the folks that with trembling hands stroked the checks in 2009 and 10 and 11, and served them very well. And I hold to the premise of time in the market rather than timing the market. I am not a good equities investor. One of the beauties of multifamily and commercial real estate in general is just a slow moving nature, and you can't click a button to get out of it. So that ultimate slowness doesn't work for everyone, but it served me well. And I think for the long-term investor, it's really a great approach, because you almost can't get out before you should, in a sense.
Right. And that's one of the things that lends to real estate's lack of volatility, like the volatility that you do see in the stock market. So I think it's one of real estate's primary selling points. Yeah, people will talk about, oh, it's illiquid, you got to stay in a deal for, 5-7 years, whatever the case may be. But in a sense, it's also an advantage because then you don't get the same volatility that you get we've seen in the stock market, which makes it more recession resistant, just less volatile in general.
Yeah, definitely. Times are changing. Like we said, values are different now. I see it every day in the mortgage business where, deals just don't size is what we say like they used to as far as loans. I'm working with a client that's working on an acquisition. It's about a $12.5 million acquisition, and the debt the seller had on it was 8.75 million. And the loan size we're looking at is around 7.5 million because it's based on income and debt coverage ratio. And when interest rates are in the high fives, as opposed to the high threes, that makes a material difference. We're talking, I mean, in this case, it's like $1 million of loan you can get. And so it's either you have to come in with more equity and there's just some price reductions. And we'll see that over the next year. Long term, again, the beauty of it is there's a growth plan in these syndications, there's value add, there's natural rent growth. Real estate in general is a great hedge against inflation because rents tend to increase as inflation occurs. And so it's a little slower moving investment vehicle, but certainly good one. The Tortoise versus the Hare story comes to mind, right? The commercial real estate's more the tortoise, but it ends up winning the race in the end.
Yeah, and you talked about some of the trends that we're seeing right now when it comes to lending, and I'm certainly seeing it and feeling it because you're right, that change from a 3 to 5 or a 6% can make a very material impact on your payments. So for those of us who had a floating bridge loan, for example, we might be feeling a little bit of pain right now. And so that makes us reassess the types of lending that we're going to be looking at moving forward. Are you seeing a shift when it comes to the types of products that buyers, operators are looking for, maybe skewing away from that bridge debt and looking at something a little longer term?
Yeah, so bridge debt was incredibly popular, and we originated a lot of bridge loans over the last few years. And for some it's most loans have a couple different constraints. There may actually be 3 or 4, but the most common are a loan to value and then a debt coverage. It's really easy for people to wrap their head around a loan to value. It's 75%, for example. I mean, it varies, but that's easy to do the math. But a 1.25 debt coverage ratio is pretty nebulous. To know some variables or how to use a financial calculator. And that's really based on the existing NOI or in a bridge loan. In the example of a bridge loan, you're looking at what the projected stabilized net operating income will be in order to get that size, the loan amount that you want. Well, on a permanent loan, we were looking at, 60, 70% in most markets was tough, but in that 60 to 70% leverage range on an acquisition. And so most people want more leverage than 60%. And so they would go to the bridge loan, which is more forward looking, and say, hey, here's where we're going to be. Unfortunately, no one anticipated that interest rates would essentially go up 2 to 3 this calendar year. And so a lot of the bridge takeouts were calculated at 4, maybe 5%. And like you said, permanent rates now can be in the 6 to 7% range. And so, yeah, we've had a couple scenarios and there's a new term that it's not a fun one. Nobody likes it, but a cash in refinance. Well, most people like the cash out, but we have done a couple of these where, hey, there was a bridge loan and business plan was executed. The NOI was increased, but just the delta in interest rates was so great that they actually had to bring cash to close. And so that's not fun. I don't know any general partners that want to have a capital call. And so there is going to be a lot of bridge loans maturing and construction loans maturing over the next year or two. So there's going to be an increased need for equity, or there may be investors or groups can make some marginal gains, not their full projected gains, but get out of the deal. So there's probably more buying opportunities over the next 12 months than we've seen, like good buying opportunities than we've seen historically. So there's pros and cons. to all of it. But I think there will be some sales that are necessitated out of that potential cash in refinance when that bridge debt matures.
Yeah, and let's talk about those opportunities a little bit more. And you're basically saying some of these folks are going to be in a bad place when it comes to where they're at with those bridge loans, and they're hitting the end of that term and they're unable to refinance, or they have to do a cash in refinance, which is the first time I've heard that term, and I don't want to have to ever use it again.
No, you don't
But
want to hear that, but
But what kind of opportunities do you think that presents for buyers? And are we going to have to get more imaginative with how we go about acquiring these deals, with things like seller financing and stuff like that? What are your thoughts there?
yeah, a couple layers to that. First, on seller financing, if anyone can get that, I always recommend that. That doesn't benefit me, but it's just simpler from a cost and execution standpoint. The way that the most loan docs read, though, it's really challenging to do any wrap. There are assumptions out there, so there may be some assumption opportunities, but by and large, to do seller financing, you need to be free and clear. So I know that there'll be a huge uptick in that sort of scenario. But as far as the opportunities, it's really a product of either the business plan not being fully executed or just real aggressive underwriting initially. And so syndicators, general partners will be faced with the dilemma when their bridge loan matures. Are we going to the capital call? Let's say they need $1 million of cash in to make the numbers work, or are they going to sell the property? And so there's been an uptick in cap rates, and so values have gone down a little bit. So exactly how to identify that opportunity offhand is a little foggy, but I anticipate there being a lot of those opportunities where that syndicator is going to need to sell in a way to save face. I don't think there's going to be a lot of losses. I'm not nervous about passive investors losing money. I'm not nervous myself about that. I mean, we may not see these monster 2-3x multiples in 3 years like have occurred, but it may be, hey, this is a 1.5 or a 1.3 equity multiple. Yeah, we didn't deliver, but we're giving you your money back. You compare that to the 40% drawdown in the stock markets, even just getting, in retrospect, if you knew at the start of 2022 to the end of 2022, you'd get all your money back, just break even. With hindsight, I think most people would just sign up for that. So I think that's what it is. I don't foresee this collapse. There's still a lot of capital out there. There's still a lot of interest in commercial real estate. Lenders are still doing deals. It's just the metrics are different than we faced before. So, but there'll be buying opportunities of people that need to sell rather than opportunistically selling because, hey, my business plan had a 5% cap rate. Broker comes to me and says we can get a 3.5% cap rate. Yeah, you transact. You do that, right? And now it's more like, hey, you got to do something to save face. So just different world we're coming into, but it's exciting. And frankly, we need to get back. It's tough to buy in that 3.5 cap rate, right? And get a return. So it's good that things are normalizing.
Yeah. And I think, like you said, there's basically opportunities in every market, be they good markets, bad markets, et cetera. And I think another important point that you brought up was the matter of perspective when it comes to being a passive investor, the costs associated with choosing one investment over another. Like, yes, you may not have gotten the returns that were projected, but what would those returns have been were it in the S&P 500 or this fund or whatever? So, yeah, I think investors need to think about that too before they get too upset that they're not getting, like you said, those 2 to 3x multiples, which were great while they lasted, but every market has cycles. And you're right, we're probably not going to see those for the next year or two, I would imagine, as things normalize, which is what it is, right? Things
Yeah.
were a little frothy, like you said, And we're going back more to normalization. So people just need to be aware of that and think about that as they're weighing their investment choices, I think.
Yeah. I know a focus of your content is the passive investor and passive investing. And I think it's somewhat lost that people aren't just investing in real estate. They think that we're talking about real estate assets and it's all about the real estate. But the beauty of it is it's actually it is real estate and it has its own merits, but you're really investing in a business and a business plan. And so if you want to just invest in real estate, buy a single family house and rent it out, or buy a REIT on the stock exchange, right? And that's the REITs buy these properties that are stabilized and just cash flowing. But in value add syndications, you get the benefits of real estate plus a simple business plan, right? There's upside, there's forced appreciation along with any market appreciation. And so it's not, while you're beholden to the real estate markets, and that's the core of the business, there is this business plan layered on top of it. You've got a real strategy to increase the income and thus the value of that business entity. And so it's the best of both worlds in my mind. And I think that that business element and that business plan to move the needle in a relatively short amount of time, 3 to 5 years, is great, especially when you look at uh, most startups, non-real estate related. It may take 10, 15 years to execute a viable business plan and have real traction and value in that business, if not longer. So a lot of good things there.
Yeah, that's absolutely true. And I think some operators don't communicate that enough that you are buying a business. Every apartment is a business. And what you're doing is you're just increasing the efficiencies on that business. You're increasing the revenue, driving down expenses, all those things that you would do in any kind of business, whether it was a pizzeria, etc. And that's why it's so important that when passive investors, like yourself, are reviewing a deal, you're really focusing in on the business plan. Like the market matters, the operators certainly matter, just like anyone running a business. But what is the plan that they have to take it from where it is in terms of net operating profits to where they want it to be to their projected? And if that plan makes sense and they're able to execute on it, then you should have a good investment on your hands.
Yeah. It's not rocket science either. It's simple enough that I can understand it. That other stuff's too complicated for me.
Yeah, and you talked earlier, I just thought it was interesting. I don't want to say dabbled, but you did some GP deals yourself and you found that it was taking up a lot of your time. And I think that's so many people don't realize that when, like you said, they go to these conventions or they get sold what is, I don't want to say they say it's passive, but how easy potentially it is to be a general partner and just buy apartment buildings and then run. It is not passive by any means, I could attest, because the more, especially with the more assets that you acquire, the more responsibility you have. So you're going to asset management meetings where you're talking with the property managers and tweaking this and that. And then you're going to the general partner meetings so that you can discuss the progress that you've made, et cetera, et cetera. And that really starts to compound the amount of time that you're investing into each of those assets. And it becomes less and less passive. So you're absolutely right. And some people learn the hard way. And it's not even really the hard way. They just learn by doing and find that maybe I don't want to quit my full time job to do this full time. And that's all right. Like I know plenty of people who have no desire to quit their full time job. They're very content being passive investors because it is so relatively easy. There's the work up front, which you talked about, vetting the deal, the operators. But after that, I've been a passive investor myself. It's pretty much, sit back, monitor, wait for those, monthly or quarterly reports. But otherwise, not a whole lot needed from you in terms of collecting that money and that K1 at the end of the year for your taxes.
Yeah. Yeah. You hit the nail on the head. had an evolution. I kind of learned by doing and figuring it out, and some bumps and bruises along the way. And all of it was beneficial. I feel like, well, to back up, I love what I do as a mortgage broker. And it was important for me to experience what my clients experience, to walk a mile in their shoes as a general partner. I think it gives me greater insight and understanding to what their challenges and demands on time are, and really what they're trying to achieve with the debt and the financing. But yeah, I I love what I do. And that general partner seat, when I started in the business, I couldn't comprehend why anyone would want to be anything but a general partner. And I've shifted the pendulum. And I think that someday I will get more into that. But the general part, not from any pretty minimal asset management fees, and sometimes they're raising ring for an asset management fee. The general partner is the last seat at the table. You pay your debt, you pay your preferred equity, you pay your common equity, and then hopefully there's something left over. And usually that leftover requires an exit to be anything material. And so, uh, yeah, it's from a cash flow standpoint, you either have to be well heeled or doing a lot of deals or constantly exiting and have some other source of income. So it's for me just cash flow and liking what I did during the day and not being able to give the time and energy to both. It made sense to make that transition. And all of it's been useful and beneficial for me as far as perspective and understanding and building my knowledge base.
Yeah, and I think that's kind of the reality check that a lot of aspiring or new operators really need. That you're not going to become get your first deal as a GP and then 3 years later you're Grant Cardone. Like that's just not how it works. It takes a while to build up that stream of income from having, that flow of deals, like you said. And as deals start to exit, and you start getting those payouts from that, and maybe you're getting that asset management fee or that acquisition fee, which are pretty minimal in reality compared to the exit. But it takes that time to build that pipeline to where you're getting, say enough income to replace if you had pretty high W-2 income. But I think it's also really important what you talked about, the perspective that even being a GP on a few deals gave you for what your clients are going through, and really being able to better understand their needs, wants, desires. Can you talk to us a little bit more about what the benefits are of using a mortgage broker? Because I think some people hear that and they're just like, "Oh, that's just a middleman. Why wouldn't I just go direct to my local bank who I already have a relationship, with?" So talk to us a little bit more about that if you could.
Yeah, thanks for the softball, Tim. I'm a little biased, and we could spend a lot of time here. But at a high level, banks exist, and that's sort of our default modus operandi, right? We say, "Oh, we need a loan," we go to a bank. Well, just speaking of banks in a nutshell, I've worked with a lot. I've placed a lot of debt with banks. First off, you have a menu, and you have just, hey, here's what we can do, take it or leave it. So if you want multiple options or to see what can bear, you got to have multiple conversations with multiple banks. And you'll probably recognize or find those that advertise at the sports events or on the freeways and that sort of thing. But for every one of those, there's at least 10 other banks that are in the shadows, or lenders that, and not shadows in a shady way, but they just don't advertise, or you're aware of them, or they may not even have a brick and mortar presence, even though they lend in your market. So how would you even know that they exist? Right? You go to that bank, maybe they only offer a 25-year amortization. Chances are there's lenders that offer that 30-year amortization that dramatically helps with cash flow. How are you going to find them? And even within the same bank, and this isn't to bag on banks. Again, I've placed a lot of loans with banks. There is a visceral difference in some of the loan officers and what they can actually accomplish within the same lending institution. And so part of what I do is vet those individuals, who gets things done. And it's amazing to me that the same loan can get done with one person at a bank. And if it ended up on someone else's desk, it might not get done or might get done at dramatically worse terms. And if you're just showing up knocking on the bank's doorstep, who's gonna who's gonna be available to answer that call or that request? It's not the man or woman that's got a ton of volume and knows how to get things done because they're busy. It's the folks that don't necessarily know how to get things done. And so, yeah, not to be disparaging of anyone, but just general principles. And aside from just banks, there's just such a wide array of different lenders and loan types that we have access to. So there's Fannie, Freddie, HUD, they're fairly well known. CMBS are tougher to access, insurance companies, and then all sorts of debt funds, private lenders, both permanent and bridge lenders. And so I came over to StackSource earlier this year, the company that I'm with, primarily because of the vision and the technology that we've developed. And so we've got a lender database of over 1,700 different lenders and loan programs for all types of commercial real estate all across the country. We've done loans that were 200,000. We've done $143 million capital stack, including debt, mezzanine, equity this year. And so we've got immense access to capital in this database, and our technology based on the deal criteria narrows down those lenders. So we're not relying on just our memory or a closed network of a handful of lenders that we're aware of. We've got this database of all these lenders. So when our clients come to us, we're able to look at the deal, analyze it, package it up in a way that lenders can digest it and get the information that they need. And we can push it out to anywhere from, on average, I would say it's anywhere from 20 to 50 different lenders we get the deal in front of. And so just the sheer volume and mechanics of that, getting it in front of that many more people and eyeballs and lenders, you're going to get the cream that rises to the top. And so you're ultimately going to get better terms. And as working with a mortgage broker, you have a single point of contact. So you're not having to have 2, 3, 4, 5. You're going to get exhausted if you're trying to have conversations with more than 3 lenders. This way you can have a conversation with one. They do the legwork. They know the lingo. They know how to get things done with the lenders. And again, I said I'd be pretty, I'm rambling on, but hopefully that's a taste.
Yeah, no. So, I mean, 2 main points there, right? Convenience from the perspective of saving that borrower time in researching all these different rates, talking to different people, but also based on the one relationships, connections, and the volume that you're capable of looking at, it's a lot more likely that they're going to get a better rate than they could had they done it on their own. Is that a relatively good summary?
Yeah. And everyone looks at rate, and rate's easy to compare and brag to your buddies at the country club about. But there's so much more that goes into it, from a structure, from a strategy. Half the time I spend with clients is just talking through what structure. What do you want to, when do you want to sell? What's the best prepayment structure on this? It doesn't make more sense to go bridge or perm. And there's a lot of nuances in all these loans that we try to figure out. And so structuring it in a way, and the best rate isn't always the best loan for the deal. And, a broker fee is usually 1% of the loan amount. That's our company standard at StackSource. And when you look at just the cost compared to what you're getting, it's really rather nominal for funding 60, 70, potentially 80, 90% when we're bringing equity to the table of the deal. And so that's a huge time saver and value add in my mind.
Yeah, exactly. I mean, you just have to, just looking at it from a simple, return on investment perspective, if you're able to get that better rate, just as, one example, that could save you whatever that 1% that you're paying to that broker is in the first place. And then that other piece that I thought was really important that I missed, you talked about, was the expertise. you've seen so many of these loans and so many of these deals that you're probably better capable of looking at it from that third party perspective and assessing what the right product is for them that buyer may not have thought of. And so that in and of itself could be invaluable in terms of, saving them when they get down the road if they had the wrong product in the first place.
Yeah. And because we have such a wide lender database, I send out a newsletter once or twice a month, just highlighting different loan programs. And most are unique. And there's lots of run of the mill programs, but just capabilities just to help people understand what we can do.
Great. Well, hey, Paul, this has been some great discussion. I appreciate all that insight you gave us on that. But now it is time to move into the turbo round. All right. So I am going to ask you 3 questions in quick succession that I ask every guest that I have on my show. And I just want you to answer them honestly. The first question is, what is one red flag every investor should look out for? And that can be a passive or active investor.
Especially for the passive, it applies to all, is the exit cap rate in any investment offering. That's hands down the most important thing in my opinion, because let's look at $1 million of NOI. A 4% cap rate gives us a value of 25 million. 5% cap rate's 20. That's a $5 million delta. It's not widely advertised. It should be in there, but that's a big thing to key in on. And what is that exit cap rate? Because that's a way to really kind of juice what returns might be or may not be. So that's my biggest red flag.
Yeah, I couldn't agree more. And one thing that we've started doing is putting like a sensitivity analysis in there basically and putting a range, right? So you talked about 4%. All right, so what will the exit be if we're at a 4 cap then? What if we're at a 4.25? What if we're at and putting that range in there so that investors can see, like in the presumably worst case scenario, it'll still be a good deal and you'll still get returns. It may not be as attractive as the expected or best case scenario, but hey, we're being open and honest and we're not just looking at it with, rose-colored glasses, assuming that the cap rate is going to go down and continue to go down in perpetuity, because we've seen that's not necessarily the case.
Right.
All right. Second question. What is a myth about this business that you would like to set straight?
Yeah, there's certainly a myth in the lending, and I think it's for more beginners, that the property will just qualify for the loan. And a lot of gurus preach that, and ultimately the vast majority of the underwriting and analysis is based on the property performance. This is investment real estate, and so the property has to support the debt or the loan. But there's got to be a warm body, a sponsor, a guarantor that meets those qualifications and has net worth and liquidity, and there's common metrics to qualify. And ultimately, there are a few loans that just the property needs to qualify, but you're not going to like the terms. I can get you that loan, but it's not what you think the rate and the fees should be. That's a myth. People figure that out, but there's a qualification and a financial strength from the sponsors that's important to qualifying for loans as well.
Sure. And I imagine, they're looking for track record as well, right? Have people done deals like this and been successful?
Yeah, experience is a big part of it. And again, that's why there's partnerships. It's tough to do these on your own. And so you need different partners that fit different roles to get things done. So that's why it's common that there's multiple people involved.
Yeah, absolutely. All right. And the final question, what does success look like to you?
Such a great question. And we could spend a lot of time here. One goal that I have is to give more every year, to give more the next year than I gave this year. I heard another podcast I was listening to, someone was commenting, if you say that money can't buy happiness, you haven't given enough of it away, meaning enough money away. And having money isn't necessarily a source of happiness, but you can accomplish a lot of good and bring yourself a lot of inner joy by giving back and contributing. So my goal, I've been blessed to be successful at that initiative of trying to give back more, not only through financial contributions, but hopefully my influence and my insight with my clients, my money with my charities, and helping further this cause. Like specifically, housing is a very important part of our lives and it means a lot to me. So that's how I'm striving for success. It's an ongoing process, but that's the most meaningful to me.
Awesome. Yeah, that's great. Well, hey, Paul, this has been amazing. Please tell our guests how they can get a hold of you and if there's anything else you would like to share with them.
All right. Well, really appreciate the time and the opportunity to visit with you, Tim. It's been a lot of fun and enjoyed it. Hopefully everyone can find a nugget or two of benefit. So my last name is unique. It's Winterowd, but it's spelled Winter OWD. So it looks like Winterowd. I joke our family either doesn't know how to spell or pronounce. I'm not sure which one it is, but it's great. You can just find me on LinkedIn, Paul Winterowd, or my email at StackSource is paul.winterowd, again, WINTEROWD at stacksource.com. And you shoot me a note, happy to include you on that email list so you can get information about some of the fun loan products that we have.
All right. Yeah. And Paul, we'll definitely have all that information in the show notes. I thought there was some really great insights here just in terms of the markets, being a passive investor, especially as compared to a GP, and all the insights you brought as a broker as well. So thanks for coming on. And I look forward to continuing to see you do big things on your journey to multifamily millions.